Chapter 10 deals primarily with long-term liabilities. We mostly talk about bonds, but also installment notes. So here are some problems from Chapter 10. When selling bonds, they can either sell at face value, for more than face value, or for less than face value. And that depends on the contract rate that the corporation is offering and its relationship to the market rate. So out in the market where bondholders can look to see where they would like to purchase bonds. So the first example says, if the selling price of a bond is less than the face amount, so selling price is less than face amount, or the market rate is greater than the contract rate. And as you can see here, the market rate greater than the contract rate. The bond is selling at, this would be a discount. The easiest way to remember this, first of all, is by memorizing this chart. It's easier when you have it in a chart form. That way you can just look and see, pick out the certain details. But once you have it in a chart form that you can memorize, it starts to make more sense the more you practice the examples. The second one says, if the selling price and market rate of a bond is equal to the face amount and contract rate, the bond is selling at. So if the contract rate and the market rate are equal, the selling price and the face amount are equal, that means the bond is selling at face amount. And then the third example, if the selling price is greater than the face amount and the market rate is less than the contract rate, so market rate is less than the contract rate, the bond is selling at a premium. So if a bond sells for less than its face amount, that's a discount. If a bond sells for its face amount, then it's sold at face amount. And if a bond is sold for greater than the face amount, it's issued at a premium. Advantages and disadvantages of bond financing. So this is a textbook problem that you can find in the back of the chapter with the other problems. Identify the following as either an advantage or a disadvantage of bond financing for a company. So all these statements are true. We just have to determine which of them would be an advantage and which would be a disadvantage. A is bonds do not affect owner control. This is an advantage. And that's because bondholders, they have no ownership interest in the corporation. They're basically creditors or lenders. So they can't make decisions that affect the corporation. Stockholders have ownership in a corporation and can affect, but bondholders cannot. So that's an advantage. B, a company earns a lower return with borrowed funds than it pays interest. This is a disadvantage. The corporation doesn't want to earn a lower amount than it's paying in interest, and this can decrease return on equity. C, a company earns a higher return with borrowed funds than it pays in interest. This is an advantage, and when that happens, it can increase return on equity. D, bonds require payment of periodic interest. This is a disadvantage. E, interest on bonds is tax deductible. Advantage, a business would like to have as many deductible expenses as possible. And F, bonds require payment of par value at maturity. This is a disadvantage. Unfortunately, when you borrow funds, you have to pay them back. Some additional examples from the homework. A bond is its issuer's written promise to pay an amount equaling the par value of the bond with interest. So the way a bond works is that bondholder purchases the bond, the issuer, so the corporation, then pays the bondholder interest, for example, every 6 months. Then at the maturity date, so the end of the bond's term, the corporation has to pay back the full face value of the bond to the bondholder. The next one, the par value of a bond, also known as the face amount or face value, is paid at a stated future date known as the maturity date. Most bonds require par or face value to be repaid at maturity and interest to be paid semi-annually. So all of those three examples kind of go together. Issuing bonds at face value or par value. Dunphy Company issued $10,000 of 6% 10-year bonds at par value on January 1st. Interest is paid semi-annually, so twice a year, each June 30th and December 31st. Prepare the entries for A, the issuance of the bonds, and B, the first interest payment on June 30th. So for A, we need to record the journal entry when the bonds were issued. So first of all, this takes place on January 1st. Then we need to look at the par value or the face value of the bonds and look at the cash that was received for issuing those bonds. So $10,000, and these were sold at par value. So what that means is the cash received is equal to the bond's face value. So to record that, we'll debit cash because the corporation is receiving cash, and we will credit a liability known as bonds payable. And that amount is $10,000. So we record the cash that the corporation received, but we also have to record the liability of bonds payable because the corporation will have to pay that back in the future. And before the bonds mature, twice a year, the corporation will have to pay interest, so on June 30th and December 31st. So in B, we're going to prepare the entry for the first interest payment on June 30th. So we know the date is June 30th. So what we're recording here is the interest expense. So we record interest expense as a debit. And the corporation is paying out that interest in cash, so we credit cash. And now we have to figure out the amount of that interest payment. So you can see that the rate is 6%. The interest rate is 6%, but that is an annual rate. And we're making an entry for a semi-annual, so only half of a year worth of interest. So the way that we compute that is we take the bond's face value, which is $10,000, multiply it by that annual rate of 6% to give us a total interest amount of $600 for the year. But since we're only paying interest for the first half of the year in this journal entry, we take that $600, divide it by 2. So on June 30th, the corporation will be paying $300 in interest. So we debit interest expense $300 and credit cash $300. This is a similar example from the homework. A company issues $400,000 of 8% 10-year bonds dated January 1st. The bonds pay interest semi-annually on June 30th and December 31st each year. If bonds are sold at par value, the issuer records the sale with a blank to bonds payable, so it's going to be a credit or a debit, in the amount of, and we have to determine the amount. So what we need to do before we can fill in those blanks is complete the journal entry for issuing those bonds. So this occurs on January 1st. We see that $400 cash was received for these bonds, and they were issued at par value, meaning that the face amount would also be the same amount as the cash received. So when we record bond issuance, we debit cash and credit bonds payable. And the amount for this journal entry will be $400,000. Another example, a company issues $100,000 of 5% 10-year bonds dated January 1st that pay interest semi-annually on June 30th and December 31st each year. If bonds are sold at par value, the issuer records the first semi-annual interest payment with a debit of what amount and to what account. So to fill in the blanks, we need to first do the journal entry for the first semi-annual interest payment. So the first semi-annual interest payment will take place on June 30th. When a corporation pays interest, the debit is to interest expense, and because the corporation is paying this interest in cash, we credit cash. And now we have to determine the amount of interest expense for that first semi-annual payment. So we take the face amount, which is $100,000, multiply it by the 5% annual interest rate to get $5,000 for the year. But remember, this is only half of the year's interest payment. So we take the total amount of interest, divide it by 2. So that will give $2,500 for the initial interest payment. So interest expense of $2,500 and a credit to cash, $2,500. So now we can fill in the blanks. So it says, if bonds are sold at par value, the issuer records the first semi-annual interest payment with a debit of, so here's our debit, a debit of $2,500 to the account interest expense. And I'd like to go back for just a moment because I realized I didn't fill in the blanks on the previous example. Actually, it won't let me go back. Journalizing discount bond issuance. So this is when bonds are issued at a discount, meaning that the cash that the corporation received for the bonds was actually less than the face value of the bonds. That would also mean that the contract rate is less than the market rate. Enviro Company issues 8% 10-year bonds with a par value of $250,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 10%. So as you can see, the market rate is greater than the contract rate. And because of that, that means that the selling price is going to be less than the face amount. And so the way that they communicate that to us in this problem they say that because the market rate is greater than the contract rate, this implies a selling price of 87.5. And so I explained this in the lecture video. Basically what that's telling us is, for instance, if a bond sells at face value, it sells at 100. So the selling price is 100% of the face value. This is saying that this particular bond sold at 87.5% of face or par value. So what we can do to figure out the selling price is to take the par value, which is $250,000, and multiply that by 87.5%. And so in decimal form, that would be 0.875. And when we multiply that, that gives us a selling price of $218,750. So that's the selling price. Notice that the selling price is less than the par value. All right, so now we need to prepare the journal entry for the issuance of the bonds for cash on January 1st. So our journal entry will start with the date of January 1st. Just like any other journal entry for bond issuance, the corporation is still receiving cash, so there will be a debit to cash. And because it's a bond, the corporation will have to repay at maturity. So that means that the company needs to also record the liability, the payable. It will have to pay back in the future. So bonds payable will be credited. So we'll do this part of the journal entry first. So the cash amount that was received that we calculated is $218,750. The credit to bonds payable will be the face value or the par value of the bonds, which is $250,000. So now we have a problem because our journal entry does not balance. Our debit column is less than the credit column. So this is where we have to use an account called discount on bonds payable. So we will debit discount on bonds payable. And we have to use this account to make up for the discrepancy between the cash received and the bonds payable amount. So what we need to do is plug in the amount that's discount on bonds payable. So if we take the $250,000, that's the face value or par value, subtract the amount of cash that was actually received, which is $218,750, that will give us a difference of $31,250. And that's the amount that will be debited to discount on bonds payable, so that then our transaction, our journal entry, will balance. Similar homework example. A company issues $75,000 of 6% 10-year bonds dated January 1st that pay interest semi-annually on each June 30th and December 31st. If the issuer accepts $69,000 for the bonds, which you can see is less than the face value, so this is at a discount, the issuer will record the sale with a debit to which accounts. So this is a homework problem, so this is going to be multiple choice or fill in the blank on the homework. But we do it the same way as we did the previous problem. We see that this is selling at a discount because face value is $75,000. The amount of cash actually received is only $69,000. So we need to, at issuance, record the journal entry. So it tells us that they were issued on January 1st. And just like any bond issuance, we will debit cash and credit bonds payable. The amount of cash received is $69,000. The par value or face value of the bonds was $75,000. So that's the amount that will be repaid at maturity. And as you can see, journal entry does not balance. Our debit column is less than the credit column. That means we need to debit another account to get our transaction to balance. When bonds are sold at a discount, we debit the account discount on bonds payable. And we debit that account for the amount that is the discrepancy between the cash received and the maturity value of the bond. So in this case, that is $6,000. And then our journal entry will balance. So bonds can also be sold at a premium. When a bond is sold at a premium, that means that the cash received is greater than the face or par value of the bonds. So it says Garcia Company issues 10% 15-year bonds with a par value of $240,000 and semiannual interest payments. On the issue date, the annual market rate for these bonds is 8%. So you can see the market rate is less than the contract rate. When that happens, bonds sell at a premium. Okay, so this implies a selling price of $117.25. So since that ratio or percentage is greater than 100, that's what tells us that the bond is selling for greater than face or par value. So prepare the journal entry for the issuance of these bonds for cash on January 1st. So our journal entry will be dated January 1st. Like all bond issuance journal entries, we debit cash and credit bonds payable. To figure out the cash amount here, we take the par value of the bonds, $240,000, and multiply that by the rate that they give us for the selling price. So we're going to multiply that by 1.1725. And that's the decimal value, the percentage value of 117.25. So when we multiply that, that's going to give us the cash price of $281,400. So that's the amount that the bonds actually sold for. So we debit cash for that amount, $281,400. Regardless of the amount of cash received for the bonds, at maturity, the corporation will pay back the par or face value of those bonds. So that's what we credit bonds payable for, the $240,000. All right, as you can see, at this point, the debit column is greater than the credit column. That means we need an additional account to credit to make sure that our transaction balances. So when bonds sell at a premium, we credit premium on bonds payable. And I'm going to abbreviate bonds payable. So to figure out the amount that we credit premium on bonds payable, it's going to be the difference between the cash received and the face value that will be repaid at maturity. And so for this instance, that amount is $41,400.